Fed has just done 3 consecutive 3/4 point raises in the last 3 months, and it's now considering doing its 4th one again next month. Right as this is occurring, just like the weather outside right now, the market is starting to show cracks that it is cooling. So what is ahead? Well, a house over here just around the corner sold in the pandemic 2020 for $460, and then early this spring sold for $505, and then again a couple months later in the spring for $562. I mean, that's a huge appreciation. But now, in the last couple months, homes within just a few blocks of here have all these homes have had price reductions. So what is it? Is it a buyer's market or is it a seller's market? Let's explore what's going on in the economy.
The U.S. central banking system, they oversee the money supply and regulate financial markets as well as set interest rates. So lately the Feds have tried to been curbing spending by raising interest rates. You know, I know we're starting to get into the recession area, and that's typically when the Feds start to lower interest rates. By doing this, it's caused a rocky market. Several other domestic and foreign issues have created scarcity mindsets within the common investor. The market went on an unprecedented run for months, even during a pandemic. I think we all probably expected some type of drawback, but I won't speculate on if we've hit the bottom or what the bottom would look like. What we're trying to stress with our clients is to have a plan, you know, especially for our younger investors. It's something that we'll continue to see throughout our lifetime. It's something that we've seen as a country not that long ago during 2008, and there will be another 2022 in the future. But that's typically what the Feds are trying to do. They're regulating the money supply in the country. So with the market and kind of what we foresee, I always tell clients the market is a series of temporary declines followed by permanent increases. And what I mean by that is, you know, March 16th, 2020, the S&P 500 closed around 2,300 points. And as of yesterday, October 24th, it closed at 3,800. So we're nowhere near where we were, which was a very, tough time, but it was very short-lived. I think the reason that the common investor is getting uncomfortable is because this is lasting a little bit longer. And that, again, goes back to that Feds, when they raise rates, it causes market scarcity.
Single-family new constructions are also starting to slow, such as this neighborhood, where all these homes were built within the last 18 months. And now, as you can see, there's just a couple construction sites and empty lots. Very little is going on. In fact, over this time last year, we've seen a 6% decrease in construction. And resales are also declining, with U.S. home prices dropping in July at the fastest rate in the history of the S&P CoreLogic Index. At 2.3%, this decrease represents the largest deceleration in the history of the index's tracking. Price cuts are also increasing, with 20% of homes cutting prices just in August, according to Realtor.com. That's the same rate as what occurred in 2017, which was pre-pandemic conditions. So is now a seller's or a buyer's market?
So there's 4 different indicators that Realtor.com looks towards when trying to decide if a shift is occurring from a seller's market to a buyer's market. First is the amount of homes becoming available. We are seeing an increase in the supply of inventory. iCar's MLS currently has 3.2 months of supply inventory active right now, which is up from the 2-month supply we were seeing in July and August, and it was even lower in June and earlier in the year. The amount of active inventory has increased overall as well. We're up 17% from this same time last year. The second metric that we can look at is how long it's taking a home to sell. Typically, homes will begin to sit on the market much longer in a buyer's market. Right now, the median days on market of a property is 35 days. This is up slightly. It was up 6% from this time last month, but it's equal to the days on market from this time last year. So this indicator is up a little bit, but it's not as strong as maybe the other ones can be. So the third indicator that we look for is if price reductions start to pick up. Our MLS does not track this number specifically, but Realtor.com does track this nationally. And what they just reported was a 4.1% increase in price reductions in properties in the Midwest year over year. This is not as significant as the double-digit percentage increases you're going to be seeing in the southern and western regions, but it is worth noting nonetheless that those price reductions are happening. And then the fourth and the final statistic to look at is how many people are applying for new mortgages right now? Bob may be able to speak about the mortgage applications here locally better than I, but just this week, the National Mortgage Bankers Association did release their data, and the mortgage applications are down 4% just this week versus last. And if you look at this week versus the same time last year, they're down 38%.
The market today is significantly different than just 3 weeks ago. But people still need to move. The problem is more sellers are reluctant to put their homes on the market. Meanwhile, builders are also slowing down on new builds. This is just exacerbating and adding to an already strained low supply housing market. So how do you navigate a volatile mortgage market?
So we do have lots of loan program options available to our customers. We have your traditional 15, 30-year fixed rate loans. We have your government loans, the USDA, the FHA, the VA. And then we also have our in-house loans that are ARMs, adjustable rate mortgages. And we will work with our customers to figure out which option is best for them depending on their needs, their credit scores, what they qualify for, and just try and help them make the best decision that is best for them. Everyone is different. Everyone has their own situations that they have to work through, and we're going to help them look at what they need. Right now, most of the time, when we look at the numbers and everything involved, the adjustable rate mortgages are the way to go for those who qualify for them, just simply due to the lower interest rates and the no PMI. And as you know, if we do a 10-1 ARM, most people aren't in their home for more than 10 years. So that really works out to be a good option for them. And honestly, even if they are in their home, almost none of them have the original loan that they had from 10 years ago. So a 10-1 ARM is really it's a very good option for most people.
But rates are a problem. So how can buyers get a leg up in this market with interest rates?
Being a local bank here, that really helps us to help keep not only the costs down, but kind of try to keep the interest rates more locally competitive versus the national scale. For example, right now on the national, the average of a 30-year fixed rate loan is somewhere in the 6.7 range, and we're in the 6.125 on the low end. So we do run quite a bit lower than what you're going to see as a national average. So you definitely want to keep your eye on the local bank, HillsBank here, and see what kind of rates we have to offer on our different loan options.
Yeah, the economy obviously right now is very fragile. Again, we're only a couple years out of a pandemic that nobody alive has experienced, or I should say most haven't. I would say I would bet on the United States economy. History typically repeats itself, especially financially, whereas we might be able to look at certain metrics from other times where the economy's down, but there's always differential pieces there. So, the war in Ukraine obviously had a big piece to do with part of the downfall of the economy. There's obviously politics that play into a factor of the economy, but ultimately, do I think the U.S. economy is running to zero? Of course not. So therefore, if you're a long-term investor, there is opportunity. There was plenty of millionaires made in 2008 because people took the opportunity to invest knowing that this has happened before and it will happen again, and the market continues to climb out of recessions.